You see, along with the friendly advice that is the old go to school, get good grades, get a good job and save for retirement, you'll sometimes hear the addition that goes with it, and that is, and invest in a diversified portfolio of stocks, bonds and mutual funds. Now, while this may have worked in the industrial age, this is actually terrible advice for today's modern world. See, no longer can companies be relied upon to take care of their retired workforce, and of course the government is running out of money for social security at a rate that is faster now than ever in history. And so the new advice floating around there now seems to be something along the lines of, you can't beat the market, just invest in the S&P for the long term. And to those that don't know any better, this can often seem like good advice. So for example, if you looked at a chart of the S&P index, which is a tradable security made up of America's top 500 companies, you'd have of course discovered that over a long enough timeline, there are indeed periods where the price rises gradually. And in hindsight, it's plain to see that certain trends were going to continue upward. But once you introduce human emotion at the time of such upward trends, a whole different picture starts to emerge. See, nobody knows when each bull market is going to start running out of steam. Investors can panic and make poor decisions. A lot of people usually enter markets too late because they experience FOMO, aka fear of missing out, and ultimately, fear and greed kick people's ass to the point of stupidity, and many of the gains made by the average investor are completely wiped out during the first sign of a market correction. So the takeaway of this is that you can't leave your finances up to chance. You've got to find a way to take matters into your own hands, and you've got to learn how to trade without emotion, which is of course easier said than done, but it is one of the things that we have to focus on as traders and investors so that we're seeing both sides of the fence and aren't blinded when markets start swinging upwards or downward really quickly.